Hello everyone. In today's video, I'll be discussing about Accounting Standard 22, which deals with accounting for taxes on income. This is one of the very important accounting standard from examination point of view. So I presume that you already have done one reading of the entire standard. It's only going to be a revision video. See, this standard, the main objective is try to understand. Let's say we are preparing profit and loss account as per Schedule 3. We show profit before tax, let's say, which is 40 lakh rupee. This will be your profit as per your books of accounts. So I will call this as accounting income. From this profit before tax, when you minus a tax expense, this tax expense, we deduct current tax. This current tax is nothing but provision for tax. And this provision for tax, when you calculate, you don't calculate that on accounting income. You calculate that based on your income tax provisions. So let's say your taxable income is 70 lakh. On that, let's say 30% tax you're supposed to pay. So I create a provision for, let's say, 21 lakh. Now, if I take this 21 lakhs as my tax expense and calculate the profit after tax as 19 lakhs, there is a mistake happening here. That is, this 40 lakhs is income as per accounts, whereas this 21 lakhs is expense as per taxation income. So we are trying to match accounting income with expense as per taxation. So that way, can I say matching concept is being violated? So the main objective of this particular standard is to bring in matching into the books of accounts. So now let us try to understand how does AS 22 help you to bring matching into the books of accounts. Okay. So I'll be dividing this entire AS 22 into 7 topics. Topic number 1, meaning of accounting income and meaning of taxable income. See, accounting income is nothing but income that is calculated as per your books of accounts. And when you prepare your books of accounts, you follow accounting standards and you follow generally accepted accounting principles. And normally we follow accrual basis. So can we say accounting income is the income calculated as per books of accounts following accounting standard, generally accepted accounting principles, accrual basis. Whereas taxable income is income as per your taxation provisions. And when you apply taxation provisions, you don't follow anything like accounting standard. You follow the provisions of the Income Tax Act. And the income may be calculated either accrual basis or cash basis. Correct. Now, we'll move on to the second topic. Topic number 2. We'll try to understand why there is a difference between accounting income and taxable income. Reasons for difference. Now, as we understood, see, accounting income is based on your accounting standards, generally accepted accounting principles, whereas my taxable income is totally based on my taxation provisions. So since the basis of calculation itself is different, so definitely there is going to be difference between both, which means in 99% of the cases, accounting income and taxable income will not match, it will be different. And this differences can be classified into two types of difference. It can be either permanent difference or timing difference. Now, what is this permanent difference and timing difference? See, let me give an example. Let's say we have paid some salary to the employee, 70,000 rupees, and this salary is paid in cash. This 70,000 salary that I've paid will be debited to my profit and loss account as per accounts, because of which my accounting income will come down. But this 70,000 cash payment will be disallowed in tax. The reason being, as per section 48 subsection 2, any payment made in excess of 10,000 other than by prescribed mode is disallowed completely, which means this 70,000 is allowed only in accounts but never allowed in taxation. Because of that, both the incomes will not match. And this difference is what we call as permanent difference, because this difference is never going to be reversed. But let's take one more example. Let's say we bought a machinery for a purpose of scientific research. Cost of the machine is 1 lakh. And since I bought it for scientific research, as per section 35, we can take 100% deduction in account in taxation. I'm sorry. So in taxation, in first year itself, you get entire 1 lakh deduction. But let's say in accounts, we are depreciating this over 5 years. So 1 lakh. So I'll be taking 20,000, 20,000, 20,000, 20,000 for 5 years. Now, because of this, if you see here, in year number one, since I've taken higher deduction in taxation, my taxation income will be lower by 80,000, correct? Whereas from second year onwards, my taxation income will be higher by 20, 20, 20 each for the next 4 years. Which means whatever difference which has arisen in year number one is getting reversed in year number two, year number three, year number four, and year number five. Which means a timing difference arises when expenses allowed in accounts also and taxation also, but different period of time. But in case of permanent difference, the expenses allowed either in accounts or only in tax. So now to understand, AS 22 defines both the differences, permanent difference and timing difference. See, permanent difference is a difference which is not capable of getting reversed in the subsequent years. Not capable of getting reversed in the subsequent years. Whereas timing difference is capable of getting reversed in the subsequent years. I hope you understood the example I have given you. So this is capable of getting reversed in subsequent years. Okay. So till now we have understood two topics. So first we understood what is accounting income and what is taxable income. And then we try to understand there are two types of difference, which can be the permanent difference or a timing difference. So just to understand it this way, if expense is allowed either in accounts or in tax only in one place, it will result in permanent difference. If it is allowed in both accounts also and tax also, but over a different period of time, it will result in timing difference. Yeah. Now, we'll move on to the next topic. How to treat these differences? How to treat the differences? Okay, which is very, very important. So the entire gist of ACE 22 is going to be understood from this particular topic. Now, how do you treat that? Now, see, we understood there could be two types of difference. One is permanent difference, the other one is timing difference. If this permanent difference, it does not come under the purview of ACE 22. Okay. So our focus will not be on the permanent difference. We'll be focusing mainly on timing difference. And when I say timing difference, my accounting income and taxable income will not be equal, correct? Both of them will not match. And when both these incomes are not matching, there are two possible scenarios. Either taxable income is greater than accounting income or taxable income is lower than accounting income, correct? See, if my taxable income is greater than accounting income, then what happens? In the current year, we end up paying more tax. Since taxable income is greater, I'll pay more tax in the current year. But because of the timing difference, if I pay more tax in the current year, in the later years, I'll be paying lesser tax. Because ultimately, because there's a timing difference, over a period of time, both the incomes need to match. Which means, in the current year, if I pay more tax, in the subsequent years, I'll be paying less tax. Which is I'm going to get a benefit in the future. So since I'm going to get a benefit in the future, the standard says, if your taxable income is greater than accounting income, you need to verify whether the difference is originating difference or whether it is responding difference. Now, when I say originating difference, it means it's a difference which is arising for the very first time. If it is originating difference, standard says we need to create deferred tax asset. We'll be creating a deferred tax asset. I'll explain the reason once again. So since the taxable income is greater, I'll be paying more tax now in the current year. Since I pay more in the current year, in the future I'll be paying less tax. which means in the future we are going to have some savings, we are going to save some tax, which is like a benefit for the company. So what I'll do, I'll create an asset for the company which is called deferred tax asset, which is only an imaginary asset now. And when I create DTA, the entry is going to be deferred tax asset account will be debited to bring the asset into accounts to the end. Similarly, if the difference is a responding difference, when I say responding, it means the difference is not arising for the first time. It's only getting reversed in the later years. If it is a responding difference, then you need to see if there is a DTL. If there is a DTL, reverse deferred tax liability, if possible, do that. If DTL is not available, then what I do, I'll again create DTL, which means either you reverse DTL if possible, but if DTL is not available, then I'll create DTA. This is how we treat if your taxable income is more than accounting income. Now, moving on to the second part. So, if your taxable income is lower than accounting income, again, you see whether the difference is originating difference or responding difference. Now, if it is originating difference, now try to understand the difference is arising for the very first time. Since my taxable income is low, in the current year, I'll be paying less tax, which means in the future years, I'm supposed to pay more tax, which is like a anticipated future outflow for me. So since I'll be paying more in the future, if it is originating difference, we create DTL, deferred tax liability, and the entry for that is going to be P&L account debit to deferred tax liability. So if it is a responding difference, if it is not arising for the first time, then what we do, if you have DTA with you, if DTA is available, reverse it, reverse DTA. If DTA is not available, then DTL will be created. So this is an important flow chart. And based on this only, we'll be solving all the questions. So try to understand. Okay. Now, let me take an example to explain the above flow chart. Let's say we'll take year 1, 2, 3, 4, 4 years. Let's say a taxable income is 11 lakh, 18 lakhs, 14 lakhs, and 10 lakh. The total taxable income for all the 4 years, 29, 43, 53 lakhs. Okay. And let's say my accounting income is 13 lakhs, 19 lakhs, 11 lakhs, okay, 10 lakhs. Let's say these are the incomes for the 4 years. Now, if you look at year number one, my taxable income is lower. Since my taxable income is lower, I'll be paying low tax now, which means I have to pay more tax in the future. And this is an originating difference. And in case of originating difference, if your taxable income is lower, what you're supposed to do, you have to create deferred tax liability. Now, for what amount should I create a liability? I'll take the difference between these two incomes, which is 2 lakh. I'll apply 30%. Let's say tax rate is 30%. So 2 lakhs into 30% for year number one will be creating deferred tax liability for rupees 60,000. Clear? Now, moving on to year number two. Even in the second year, your taxable income is only lower. Now let's say this is not a fresh difference coming up. This is the same, like whatever difference which has arisen in the first year, let's say it's continuing in the second year also. Okay, now it's a responding difference. Now your taxable income is lower. So when your taxable income is lower, what does the standard say? If it is originating, you create liability. If it is responding, if you have the asset, reverse it. But in this example, we don't have any asset. In year number one, we created liability only. So we cannot reverse the asset. So what am I going to do again? Create liability. The difference is 1 lakh. I'll apply 30% on that. So we create again DTL 30,000. Which is in my balance sheet, the deferred tax liability will be available for 90,000. Now, moving on to year number three. Now your taxable income is greater. Now, if it is originating difference, I would create deferred tax asset. So, but it's responding difference. I'll not create asset. I would rather what I'll do, reverse the deferred tax liability. Now I'll see here, I'll reverse DTL. The difference is how much? 3 lakhs. On that, I'll apply 30%. So I'll be reversing DTL of rupees 90,000. That way, the deferred tax in my balance sheet becomes zero. And in year number 4, there's no difference. So I don't create any deferred taxes. I hope all of you are understanding this. So that way, you need to understand which income is greater or which income is lower. The second thing you need to understand whether the difference is a fresh difference or responding difference. Okay. Now, sir, how does this creation of deferred taxes will help in bringing matching concept into the books of accounts? That let me explain with the help of year number 1. Now just look at year number 1. If I prepare my profit and loss account as per schedule 3, let's say my profit before tax, this is nothing but my accounting income is 13 lakhs. From this, we will less a tax expense, correct? Now, tax expense is a combination of two things, current tax. Okay, first let's take current tax. This current tax is nothing but provision for tax, which I'll calculate based on my taxable income. And my taxable income is how much? 11 lakh. Let's say on that I'll create 30%, which is going to be 3 lakh 30. Now, in year number 1, I'm supposed to create a deferred tax liability. And when I'm creating a liability, the entry is going to be P&L account is debited to deferred tax liability. So DTL created. So when I'm creating DTL, the entry is P&L account debit. And if I'm debiting my P&L, it's like an expense. Your expense gets added up. So 330, 60 gets added up. So in the outer column, I'll show the total expense as 3 lakh 90. And can I say this 3 lakh 90,000 is nothing but 30% of my accounting income? Now we are matching our accounting income with expense as per accounts only, which is by creating deferred tax liability, you're trying to bring in that matching into the books of accounts. Clear? And ultimately, my profit after tax is going to be 7 lakh 10,000. Let's move on to topic number 4. How do you do accounting for this deferred tax? So let us understand how to pass journal entries for this. We'll take one more example. Let's say year number 1, year number 2. A taxable income is 11 lakhs and 18 lakhs, 29 lakhs for 2 years. And let's say accounting income is 17 lakhs and 12 lakhs. Now, in year number 1, if I see, my taxable income is lower. And since my taxable income is lower, I'll be creating deferred tax liability. So DTL to be created. This is what I'll be doing in year number 1. Now, what is the journal entry going to be for this? Profit and loss account will be debited to deferred tax liability. And when I make this entry, so DTL will be created for, I'll take the difference of these two, which is 6 lakhs. On that 30%, let's say tax rate. So 1.8 lakhs will be your deferred tax liability, correct? Now, in addition to deferred tax, you need to create current tax also. So which is nothing but provision for tax. So the entry for that will be profit and loss account debit to current tax, correct? And this current tax is always calculated on my taxable income. And what is my taxable income here? 11 lakhs. On that, I would create 30%. So which is going to be 3.3 lakhs. Now, instead of passing two entries like this, if I have to give the combined effect, can I say the entry is going to be profit and loss account will be debited to deferred tax liability. I'll be creating 1.8 lakhs to current tax will be 3.3 lakhs, which means totally P&L account will be debited with 5.1 lakh. And if you see here, this 5.1 lakh is nothing but 30% of the accounting income, which means we are matching the accounting income with expense as per account. So we are bringing in matching into the books of accounts. Clear? So what we'll do each year, instead of passing multiple entries, we'll try to simplify and just make one combined entry. So what is that entry? So just to conclude this, always current tax is going to be great. And then you're crediting the current tax. This is always calculated on my taxable income, applying the tax rate. And deferred tax asset account or liability account, depending on whether you're creating or reversing, you need to think and do that. And P&L account will be balancing figure. Now, just to conclude, current taxes always credited, and DTA if you're creating debited, DTA if you're reversing credit that. Same way DTL if you're creating credit the DTL account, and DTL if you're reversing debit the DTL account. So current tax is always going to be created, and deferred tax asset and liability, depending on whether you're creating or reversing, you decide whether to debit or credit. P&L account, I'll just take the balancing figure. P&L account, I'll just take the balancing figure. I hope all of you are clear. This is how the journal entries will be made for deferred taxes. Let's take one more example just to understand the concept. Let's say here 1, 2, 3 years I've taken taxable income 10 lakhs, 18 lakhs, 14 lakhs, a total 42. And let's say accounting income is 9 lakhs, 14 lakhs, 19 lakhs, totally 42. Now, let's say tax rate is given in the question 30%. Now, in year number 1, taxable income is greater. Okay. And taxable income is greater, we are supposed to create deferred tax assets, correct? So year number 1 journal entry will be, since I'm creating the asset, debit DTA account. We'll take the difference of 1 lakh and apply 30%. So DTA account will be debited with 30,000. Now, current tax is always going to be credited because current tax is nothing but provision for tax. And this will be always on my taxable income. So on 10 lakhs, I'll apply 30%, which is going to be 3 lakhs. The balancing figure, I'll put it in P&L account. So P&L account will be debited with 2.7 lakh. And if you observe here, this 2.7 is nothing but 30% of my accounting income of 9 lakhs. So that way matching is taken care of. I would recommend you to take P&L always as a balancing figure. The reason being, when tax rates change every year, the matching concept is not actually taken care of. So that is the reason I'm asking you to take the P&L as a balancing figure. Clear? Now, why that happens, we'll understand in the coming examples. Anyway, now moving on to year 2. If you look at year 2, again my taxable income is only greater. And this is responding difference. See, when taxable income is greater, if it is responding difference, what we're supposed to do, we need to reverse liability if it is available. But if liability is not there, I'm going to again create deferred tax asset, which means in year number 2 also, I'll be creating deferred tax assets. So the entry is going to be DTA will be debited. Take the difference 4 lakh, apply 30% on that. So DTA will be debited with 1.2 lakh. Current tax is always credited. This is on my taxable income. So which is 18 lakhs. On that I'll apply 30%, which is going to be 5.4 lakh. So the balancing figure will go to P&L. So P&L will be debited with 4.2 lakh. This is what I'll do in year number 2. Now, similarly, if I move on to year number 3, now if you see, in the third year, my taxable income is actually low, and it's a responding difference. So when your taxable income is low, what you're supposed to do in case of responding difference? Reverse DTA if it is available. And in this question, we have already created 30,000 in year 1, 1.2 lakhs in year 2, which is in the balance sheet, we'll be having 1.5 lakh DTA. And in year number 3, if you see exactly, the difference is 5 lakhs, 30% of which is 1.5 lakh, which is in third year, we are going to reverse the asset. Whenever you reverse the asset account needs to be credited. So I'll credit DTA with 1.5 lakh. Current tax is always credited. So I'll calculate this on taxable income, 14 lakhs into 30% of that, which is 4.2, which means my P&L will be debited with 5.7 lakh. This is how you do accounting for deferred taxes. Okay. Now, let's move on to the next topic, which is very, very important topic. Yeah. See, Whenever you create deferred tax asset, you are making an entry deferred tax asset account debit to P&L, correct? Which means you're crediting the P&L account, so you're treating it like an income. And when you credit P&L, there are two implications. Either your profit is overstated. If it is profit, it gets overstated. Similarly, if it is loss, it gets understated, correct? Now, just when you create a deferred tax asset, it's resulting in increase in your profit or reduction of your loss, correct? So can I say the conservatism concept may be getting violated when you create deferred tax asset? Therefore, AS 22 says whenever you're creating deferred tax asset, you need to verify whether certain conditions are satisfied or not. Anyway, but before understanding these conditions, let's take one example. Let's say my accounting income for 3 years, let's say year number one, 9 lakh, year number two, 4 lakhs, year number three, 7 lakh. Now, assuming there are no timing differences, except that this loss can be carried forward and can be set off in the subsequent years as per Income Tax Act. And as per Income Tax, you can carry forward and set off for 8 years. That way, my first year taxable income will be 0 since we made loss. In the second year, out of 9 lakh, 4 lakhs is going to be set off. So again, taxable income is 0. In the third year, out of 9 lakhs, since 4 lakhs is already set off, the remaining 5 is going to be set off. So I'll set off 5. So your taxable income is going to be 2 lakh, correct? Now, let's say tax rate is 30%. Now, what we are supposed to do each year? Now, if you look at year number one, your taxable income is greater. Since your taxable income is greater, in year number one, you're going to create deferred tax assets. So I'll take the difference of these two, 9 lakh, apply 30% of that. So 2.7 lakhs, I'll be creating an asset which will appear in my balance sheet under the heading non-current assets. Now, in the second year, if you see, my taxable income is low, correct? Now, this is a responding difference. When your taxable income is low, if it is a responding difference, we need to reverse DTA if possible, correct? Now, I'll take the difference of 4 lakh, apply 30% of that. So 4 lakhs, 30%. So 1.2 lakhs, I'm going to reverse. Out of 2.7, 1.2 gets reversed. So in my balance sheet, another 1.5 lakh will be left, correct? Now, if you look at year number 4, sorry, year number 3, again, my taxable income is lower and this is responding difference again. So because it's responding difference, again I'm going to reverse DTA. So I'll take the difference again, which is 5 lakh into 30%. So I'll reverse 1.5 lakh DTL, which means in my balance sheet, DTL is going to become 0. Now, for this example, if I have to create my profit and loss account, so let's create profit and loss account for year number one. We'll just explain for year number one. So you should be able to do for year 2 and 3. So let's start with profit before tax, which is nothing but my accounting income, which is negative 9 lakh. From this, less tax expense. This tax expense is a combination of two things. One is current tax, correct? So current tax of year one, if you see, your taxable income is 0. So your current tax will be 0. In year number one, DTA is created. Correct? If you look at year number one, we created DTA. So the entry is going to be deferred tax asset account debit to P&L, which means when I create an asset, P&L account is getting credited. And if you're crediting your P&L account, it's similar to an income. So if it is income, can I say your expense will reduce? So DT is created. So my expense will reduce by 2.7 lakh. Okay. So I'll put this 2.7 in the outer column. Now it is minus of minus 2.7. You have to be a little careful here. So minus 9 lakh plus 2.7 lakhs. So this is going to give you 6.3 lakhs negative, which means when I created deferred tax asset, I'm understating my loss. See, if there is no deferred tax asset, my loss would have been 9 lakh. But because I created this asset, instead of 9 lakh loss, I'm reporting only 6.3 lakhs to the users. Which means whenever you create a deferred tax asset, you are understating your losses. Or similarly, if there's a profit, you are overstating your profits, correct? So therefore, the standards say, if you want to create deferred tax asset, you have to satisfy certain conditions. Now, for that, again, you need to verify what is the reason behind this deferred tax asset coming into books. If DTA is because of carry forward losses or because of unabsorbed depreciation, you have to see what is the reason it's coming into your books of accounts. So, if it's carry forward losses or unabsorbed depreciation, then the standards say you can create DTA only if there is virtual certainty. There should be virtual certainty, which should be supported by convincing evidence. And that should be supported by convincing evidence that there is sufficient future profitability. There is sufficient future profitability against which DTA can be reversed. Now, there are four keywords that you need to remember. There should be virtual certainty, convincing evidence, sufficient future profitability, and DTA can be reversed. Now, let me give an example. Let's say first year company suffered loss. So taxable income will be zero. They'll create deferred tax asset. So loss will be understated. Second year again loss. Again I'll create DTA. Third year again loss. Again DTA. Fourth year again loss. Again DTA. This way, if you keep creating DTA year after year, the deferred tax asset goes on getting accumulated. And in the balance sheet, simply you're inflating an asset and you're understating loss, which means it's a clear violation of conservatism concept. Sir, you can create deferred taxes only if it is capable of getting reversed subsequently. But now, because you're continuously getting losses, the deferred tax is not going to be reversed. Which means that is going to be reversed only if there is sufficient future profits. And it cannot be just positive thinking that I'm going to get sufficient future profits. And there should be virtual certainty that there is going to be future profit, and that should be supported by convincing evidence. So only if I have that certainty that the profit is going to come in the future, I can create DTA so that it can be reversed in the future. Okay. Now, in simple words, you can create DTA only if there is virtual certainty. There should be convincing evidence. There should be sufficient future profitability against which DTA can be reversed. Similarly, if DTA is because of any other reason, I mean to say other than carry forward losses or unabsorbed depreciation, any other reason, the standard does not ask for virtual certainty. It is simply reasonable certainty is enough. And it did not demand even for convincing evidence, simply reasonable certainty. And there should be sufficient future profit, and DTA should be capable of getting reversed in the future. DTA can be reversed in the future. Now, these are certain conditions which are to be satisfied if the organization wants to create DTA in their books of accounts.